Are you looking for a podcast that's entertaining, more bingeable than your favorite Netflix show, and informative? The Personal Finance Podcast teaches you the hacks, tips, and tactics you need to upgrade your money, all while spending less and saving more. This isn't a show that teaches you to save money by clipping coupons. It's much more about learning how to build generational wealth and spending your money on the things you love. Search for the Personal Finance Podcast on Apple Podcasts, Spotify, or wherever you listen to podcasts. Your wallet will thank you later.
If you've been struggling to fall asleep or stay asleep, try listening to a guided meditation tonight on the Sleep Meditation for Women podcast. Meditations are a natural, easy way to quiet your mind and relax your body so you can get the sleep you need. Every night, Sleep Meditation for Women provides a new episode, from body relaxations to guided visualizations and even dedicated sleep sounds. Listen for free now by searching Sleep Meditation for Women on your favorite podcast player and begin sleeping better tonight.
This is Optimal Finance Daily, episode 2356. What Really Happens When You Move Up a Tax Bracket by Farrington of thecollegeinvestor.com. And I'm your host and personal finance enthusiast, Diana Merriam. Welcome to another Monday Mastery episode here on Optimal Finance Daily, where each Monday we take a look at an article that features a more complex personal finance topic. So with that, let's jump right into this next article and start optimizing your life. What Really Happens When You Move Up a Tax Bracket by Farrington of thecollegeinvestor.com. Have you ever heard of anyone complaining about making more money? If you have, they probably grumbled about moving up a tax bracket. Many people assume that when they move up a tax bracket, every dollar they earn is taxed at a new higher rate, leading to lower take-home pay overall. Thankfully, that isn't the case. When you move up a tax bracket, you only pay a higher tax rate on the income above a threshold. The rest of your income is taxed at the same rate or rates as before. In this article, we explain what it really means to move up a tax bracket, how to calculate your tax bill, and the possible downsides of earning more. What does moving up a tax bracket mean? The United States has a progressive income tax code. That means that the first dollar you earn is taxed at a lower rate than the last dollar you earn. It's important to note that the United States taxes your adjusted gross income, or AGI. Adjusted gross income is all of your income subject to income tax, wages, business profits, dividends, interest from high-yield accounts, etc., less any deductions and adjustments you're entitled to. For example, if you don't itemize your taxes, you'll still qualify for the standard deduction of $12,950 for a single filer or $25,900 for a married couple filing jointly. An individual claiming the standard deduction gets $12,950 in income tax-free money. If she earns exactly $12,950, her adjusted gross income is zero, so she pays no taxes. If she earns more than $12,950, her adjusted gross income is taxed. Her first dollar earned above $12,950 is taxed at 10%, but the rate gets progressively higher as she earns a higher adjusted gross income. The income brackets change if you're married filing jointly, married filing separately, or a head of a household filer. Good news. Earning more means taking home more money. As you earn more money, you'll pay more in taxes. And when you cross into a new tax bracket, some of the money you earn will be taxed at a higher rate. But not all of your money will be taxed at that higher rate. When you earn more money, you should see a bigger paycheck. The one caveat to this is that many raises coincide with the start of the year. That's also the time when your benefits change. In some cases, the rising cost of health insurance or other changes you make could cause you to see less money in your check even though you're earning more. Bad news, you may no longer qualify for certain benefits. While you're almost always going to see a bigger paycheck when you earn more money, earning more isn't always a panacea. In some cases, earning more money means you fall off a benefits cliff. That means that by earning more, you may suddenly be disqualified for certain benefits. This issue is particularly pronounced for many working people who earn less than average wages for their area. Here are a few examples. Before his most recent promotion, Robert qualified for $60 per week in SNAP benefits. With his most recent raise, he earns $3 per hour more than he did previously. He loses his SNAP benefits. Assuming he works 40 hours per week, his pre-tax pay rises by $120 per week, but he loses $60 in benefits. Once taxes are taken out, his earning is just a touch higher than it was before. Before her promotion, Nina's children qualified for CHIP, or the state-run health insurance plan. After her $5,200 annual raise, the children no longer qualify for the program. She has to pay for their insurance through her employer. The cost of adding the kids is $300 per month. That means that $3,600 of her raise goes straight towards replacing a benefit that she previously received for free. Hannah qualifies for a Section 8 housing voucher. Under the terms of her voucher, exactly 30% of her income goes to housing. When she gets a raise of $2 per hour, she'll earn $350 more per month on average. Her portion of the rent increases by $105. If her earnings go too high, she may be disqualified from the housing voucher program completely. Self-employed people who buy insurance through the healthcare exchange or healthcare.gov may see their premium tax credits fall as their income rises. The result may be that earning more money could translate into paying more for health insurance, or worse, paying back some of the premium tax credits when you file your taxes. It can be discouraging to work hard to earn more, only to have the extra money be eaten up by paying for benefits. It's especially discouraging when you can barely afford the new expense. In spite of losing out on these benefits in the short term, I would encourage you to continue working to earn more over time. Once you're accustomed to paying for certain things out of your paycheck, each dollar you earn will move you forward financially. Why does your tax bracket matter? Since most people slowly inch up from one tax bracket to the next, it may not seem like tax brackets are particularly meaningful. After all, you're going to pay taxes no matter what your bracket is. However, understanding your normal tax bracket can help you take advantage of years when you earn less than average. For example, if your business takes a loss one year, you may want to take advantage of being in a low tax bracket to convert some money from a traditional IRA to a Roth IRA. That way you get the advantage of paying tax at a low rate now and then avoiding any tax on it in the future. You could also consider making moves like capitalizing business expenses rather than expensing them. Or in a year when you have a particularly high tax rate, consider making large charitable contributions during the calendar year rather than putting them off. Your expected tax bracket may also influence you to increase or decrease your withholdings at work. You just listened to the post titled, "What Really Happens When You Move Up a Tax Bracket" by Robert Farrington of thecollegeinvestor.com. Did you know that even if you have health insurance, you could still be overpaying for your prescription medications? Before you fill your next prescription, just checking GoodRx may help you beat your copay price. GoodRx is the fast and free way to save up to 80% on the price of your prescriptions. All you need to do is search for your medication on the GoodRx website or app and show your discount at the pharmacy counter. It's that easy. Not to mention, GoodRx doesn't just work for new prescriptions. It can help you save big on all your refills too. You know how much frugality means to me and how many ways I try to save, but never before have I seen a way to save on prescriptions. I've really loved GoodRx. It's extremely easy even for the older members of my family that I've recommended it to. So for simple, smart savings on your prescriptions, check GoodRx. Go to goodrx.com/OFD. That's goodrx.com/OFD. goodrx.com/OFD. My friend Frank Vasquez over at Risk Parity Radio has said that many times when we worry about taxes, we're stepping over dollars to collect pennies. That's not to say that we shouldn't be strategic. There are plenty of ways we can think about lowering our lifetime tax burden. but death and taxes are just a reality of life. And when you fight with reality, you may be creating unnecessary suffering for yourself. As Robert stated in this article, it's always better to earn more, and I agree with that. I will also add that when you reach a place of financial security, you can take advantage of earning less. For example, in 2022, my taxable income was so low that I received 100% of the premiums I paid for my ACA health insurance back in my tax return. Due to my self-employment status, I'm never 100% sure what my income's going to be. So I opt to pay full price for my health insurance. And then if I end up qualifying for subsidies, I'll reap the rewards come tax filing time. This also helps me to avoid having to pay back any applied subsidies that I may end up not qualifying for. Another thing I didn't notice mentioned in this article is that there's a lot of confusion over marginal versus effective tax rate. A taxpayer's average tax rate or effective tax rate is the percentage of annual income that they pay in taxes. By contrast, a taxpayer's marginal tax rate is the tax rate imposed on their last dollar of income. These can be two very different numbers. For example, the marginal federal tax brackets range from 10 to 37%, but the average effective tax rate across everyone with taxable income is about 14%. And if you're making less than 6 figures, it's less than 9%. But that'll do it for this episode. Have a happy rest of your day, and I'll be back with you again tomorrow, where your optimal life awaits.